All right, thanks very much for having me to discuss this really interesting paper. I have to admit that when I first saw the title of the paper, I was a little confused. So I think I could make sense of, already made the mistake once, clicking the wrong button, information cycles, but I wasn't quite sure what business liquidity meant. And then I realized, staring at the title again, there's actually a comma here, which is actually missing on the program. So it's actually not really business liquidity. What we're talking about here is really business cycles, liquidity cycles, and information cycles. And that's really what the paper is about. It creates a very rich and, I would say, cleverly crafted, there's a lot of craftsmanship going into this model, a model of business cycles, liquidity cycles, and information cycles. And there's a lot of stuff going on in that model. And well, there's general equilibrium. The authors are macroeconomists. There's aggregate risk. We want to talk about cycles. There are heterogeneous firms, investment and production. And if you have all these four elements already together, typically you're about to run in a big mess, and I learned that the hard way myself. The authors don't, but rather they add more elements. There's incomplete information, there are liquidity shocks, there are stock traders, actually two kinds of stock traders, there's learning from prices and so on. And it's a very rich model, but what I like about it that in spite of that, all that sophistication and richness, the key mechanism and the key intuition is actually quite intuitive and quite simple. And I think what's going on is that in many recessions, more traders face liquidity needs. They need cash. They start dumping stocks on the market. That leads to declines in price informative. And to the extent that prices are informative about fundamentals, that it leads to a deterioration in allocative efficiency. And as we've learned from Joel and Killian yesterday, if allocative efficiency deteriorates, that comes with TFP losses and output losses. So I think that's a fundamental mechanism that's going on here. So I see that primarily as an applied theory paper. So I thought it'd be a good idea to start by breaking down the model a little bit, and then I'm going to comment on some of the interpretation here. So we basically need a model of allocation or misallocation, and the way that works in the model is that there's a mutual fund basically that takes, I guess, savings from the household and allocates to I firms that have this production function that involves assets in place, idiosyncratic productivity or profitability, and they invest, and there's some adjustment costs here. Okay, now. In a complete information benchmark, suppose we knew what that C over here would be. This problem has a very easy solution. And it just says capital flows to the most productive firms in the sense that the capital is proportional to the productivity. That tells us that the kind of marginal products here, which we can kind of loosely define that way, are constant across the firms. Therefore, the dispersion of MPKs, which often is taken as a measure of misallocation, is going to be zero here. Okay? Now, the real world is a little more complicated. We typically don't see productivity right away. So basically, we need to make a forecast about what productivity could be. And I guess here it's the mutual fund manager who needs to make a forecast about productivity based on their information set. Now, that's a forecast. Ex-post realizations can be different, so there are forecast errors. So that leads to misallocation in the sense that sometimes productive firms get little capital and unproductive firms get a lot of capital. Now, as Joel made clear yesterday, it's not entirely obvious to what extent that's misallocation in the sense that policymakers could do anything about it. They could create more information, but it's not exactly obvious what that would mean. Now, of course, in terms of the model, we need to kind of know what that information set here is. So basically now the next block for the model makes clear what that information set is based on which mutual fund managers can make forecasts. So that is basically some sort of a noisy irrational expectations, Grossman-Stiglitz type of model. So there is an observable component of productivity, there's an unobservable component, there's an aggregate component, and one that's observable at a cost. I guess there are stock traders out there You can think of them as hedge funds. They're gathering information that's costly, and they're going to able to uncover some of that on a observable productivity here. Then there's another class of traders, and these are liquidity traders. That's a fraction gamma here. And they need to liquidate some of these stocks early for liquidity purposes. That's where the liquidity component comes in, and the liquidity discount also has an unobservable and an observable component. Now that's noisy irrational expectations type of world. There's Bayesian updating, and as Gorkem has made clear, the authors work really hard to make this very tractable and ending up with this simple linear pricing function. So there's a market price of that stock, and that's not fully revealing, and it reflects liquidity discounts and productivity here. Now, what's important in this context is there's one key assumption here, namely that the mutual fund manager who makes the capital allocation decision, the only thing that manager sees is the now I have to go back, is the price here. So there's misallocation because the mutual fund manager is going to make capital decisions based on the forecast, based on the price, rather on productivity itself. So that gives rise to a key inference problem. Now, is a stock price, is it going to be high because the company is productive or because there are low liquidity needs? Or in other words, is a stock price going to be low because the company is unproductive or because investors just dumped a ton of their shares on the market? So that's a key inference problem. So in some sense, that's a model of endogenous noise. So Grossman-Stiglitz just have a number of noise traders. Here, the noise that's created through these liquidity trades is actually endogenous. So we have a model of misallocation. We have a model of incomplete information. So the only thing that's left is a model of cycles. And the way that's done here is that there are two aggregate states. So aggregate productivity here, and the fraction of day traders that need to liquidate early is follows jointly a Markov process. So it can be there are recessions where aggregate productivity falls. There are recessions where mostly liquidity needs go up. And these are kind of jointly correlated. So these are business cycles and liquidity cycles, and those drive information cycles because information acquisition and price informativeness basically depend on that aggregate state. Now, the key results here, and I've kind of alluded to that already at some level, is that liquidity shocks here amplify business cycles. Because if there's more liquidity needs out there, the price gets less informative, and allocative efficiency is going to deteriorate. That comes with output losses, and so on and so forth. That's an amplification result, a classical macro amplification result that makes, if liquidity concerns are important, then bad recessions get worse, and actually get a lot worse. They get almost 100% worse. And so what's nice about the setup that Gorkem presented, that they have linear pricing functions, so they can actually provide some empirical evidence on these effects. So there's some cross-country evidence that price informativeness indeed declines in time of distress. So that's kind of very reaffirming here. So I think that's a very plausible mechanism. I have to say I spent a large part of my adult life trying to calibrate and quantify a simulation-based model. So I would say at this point I think I believe the directions, but the effects are really, really large. So these liquidity shocks amplify recessions by potentially up to 100%. And I've kind of played with these financial accelerator method models, for example. The amplification, it's not so easy to get. So I'm kind of trying to interpret where that might come from and to what extent that's realistic. So I'm going to be trying to comment a little bit and think a little bit about the mapping between the model and the data here, which basically is a question: how do the secondary market prices and trading really affect real allocation decisions? And in some sense, that really depends on how you think about the capital allocation decision in this context. And now you can interpret the paper in two ways. You can take the model literally. Then this is about mutual funds taking savings from households and allocate them to companies. Now, I was thinking about that a little bit, and it's actually not that far of a stretch, because what I've learned is that active mutual funds are actually some of the main buyers an active participant in the primary market. So in IPOs, it's a lot of active mutual funds that at least used to buy those shares. So that would be basically a statement about model about primary markets and issuance markets. And I think it's very plausible that secondary market prices kind of serve as signals for issuance decisions, certainly in SEOs, but probably also in IPOs. Then you can kind of interpret the model a little more metaphorically, in the sense that we need a representation in the model how prices might affect go into real allocation decisions. And then we could say, well, at the end of the day, what we think, probably who takes the capital allocation decisions are companies and probably their managers. Now, I think the authors have more a metaphorical interpretation in mind, but then we have to ask ourselves, do companies or their managers, do they learn from prices? Do they learn from prices about fundamentals, productivity? And do they exclusively learn from prices about fundamentals here? And so thinking about fundamentals first, do managers really learn fundamentals from stock prices? So in some sense, you could think there's a lot of ways in which managers could learn about demand or productivity. And I guess internal data would be, they observe share sales and so on and so forth. They have cash flow forecasts. That's probably something they would want to rely on. Then we live in a data-rich world. We can invest in the production of data, I guess. Amazon knows already now what I'm going to order next, which I don't. So they know a lot better than I do. Google happily sells search data about what people are searching and demand, I'm guessing, to companies. So that's a source of information. Then, of course, you could think that stock prices and asset prices more generally, it doesn't have to be a stock price, which is partially revealing about the productivity as well. Now, when we think about stock prices, I have to say, and I learned most about that I know about misallocation from Joel, and he has a paper with Wenke and Hugo Hoppenheim, where they quantitatively try to tease out how much can we really learn about fundamentals productivity from stock prices. And I think the result they find is it's actually probably rather on the smaller side. And that sounds about right to me. I mean, the correlation of stock prices with fundamentals is kind of low, and the average volatility of an average stock in the US on an annual basis is about 50% on an individual stock. It's hard to imagine that this is fundamentally driven. So I think there's just a lot of noise in stock prices. There's retailers, there's liquidity traders, there are passive investors, which are not really that price sensitive to begin with. I might come back to that later. So now that's not to say that companies don't learn from stock prices. It's more a question, do they really learn about productivity? So what could managers learn from stock prices, for example? Well, they could learn about the cost of future equity issuance. So basically, when stock price is high, it's probably a good time to issue. Now, to some extent, they could learn about the cost of refinancing the debt market, because stock valuations are informative of default probabilities. Now, if that's not productivity driven, then what is it? And I guess in the language of current demand-based asset pricing, we would say that might be learning about latent demand. So good example, the GameStop episode, like retail traders coordinate on Reddit, bid up GameStop prices, probably to punish these mean hedge funds who had been selling them short and push them into a short squeeze. That's probably non-fundamentally driven, but if these demand shocks actually drive up stock prices, it might be a good idea to issue equity and to using the proceeds for yes, I'm not quite almost done, but I'm almost done with my next point. So, and actually, that's an interesting paper by James Cho, who is actually trying to do that by Jaewon Cho and friends, who are trying to tease out latent demand shocks from the data and relate them to what companies actually do. And what they find is that, well, when there's latent demand shocks that push up valuations, companies are going to happily issue equity. And some of these proceeds are actually going to be invested. Now, what you also find that's interesting, in these typical cases, that actually contributes to misallocation. So MPK dispersion goes up, and that's probably because some of these investments that they're making when acquisitions are temporarily cheap is not necessarily efficient. So in some sense, what you could say is probably they do learn, managers, companies do learn something from stock prices. They might not learn about productivity, and whatever it is that they learn about, it might not actually help allocative efficiency. So in some sense, perhaps as a last quick point here, I want to say, come back to that more literal interpretation, which seems kind of actually quite interesting to me in that sense that active managers contribute to IPOs, to capital allocation. And the reason I came up with that was because I was reading an article in the FT not too long ago, which was arguing that the waning of active funds is drying up the IPO market. So in some sense, the outflows from active funds led to a decline in IPOs. Now that probably was related to what the economists called the big sleep, basically the growth of passive funds, which probably makes prices less informative to begin with. But if you have the decline in IPOs, growth in passive funds, what we've also seen at the same time is the rise of the privates. So a lot of companies are now taken private. A lot of investors invest in private assets, which makes me ask us somewhat more philosophical questions. Do investors and their companies, do they actually want to learn from prices? Or are they trying to do whatever they can to be unaffected, shielded from all that noise in stock prices? Okay, I didn't get to talk about my own work. Too bad, but good for you. So I think it's a really great paper, really interesting. I learned a lot. I think it's cleverly and really beautifully crafted. I think the mechanism and the intuition are very plausible. I think I call the quantitative, I'm going to call them qualitative or quantitative. I think they're very plausible, but maybe they should be taken as what they are, as qualitative. Thanks very much.